Hello everyone. Today I'll be going through my stock portfolio and the planned trades that I have going forward for next week. Year to date, I'm up 250%. I started this year with roughly $4,800 in the account, and now it's at $95,945. Along the way, I've deposited roughly $33,000 in this year as well. Here is my trade activity or account activity for the week. As you can see, my margin balance has increased considerably. I purchased 18 shares at $373 average, giving it a total of $6,700. So as a result of this margin balance increase of $40,000, bringing my total margin balance to $64,613, I will not be writing any more sell puts this week. Overall, my strategy has been to hold Tesla long term and then to write sell puts. And when those sell puts are assigned, then I turn around and write call options at the exact same strike price until those stocks sell off through the call options. And then I turn back around and do the sell puts. When I wrote many of these sell puts, they were quite a bit out of the money, and it was at the peak of my account, which was $136,000. When my account dipped down because I'm so focused or concentrated in Tesla, there's a huge impact when that price drops down. I could still take a dip of Tesla going down roughly $100 and still be fine. The main account that holds Tesla, you can see there's really not much change for the activity. It's roughly $4,000 increase. There wasn't a whole lot of price change on Friday. Moving to the right side, Friday, several hours after market close, you can see we only have one option that is in the money. The CCJ sell put at 11 strike price. So that's 10 contracts, which is 1,000 shares. That brings my total margin balance up for the week by $40,000, or since 9/8, and bringing the total margin balance to $64,000. And my maintenance balance, as a result, had dropped because the way that they do the sell puts for this brokerage is they assign it as if this option would become completely worthless. So I would be on the hook for $11,000 if the stock ran to zero. Okay, so let's move on to my planned trades for next week. I will be just writing call options on the existing positions that I have. So my first planned trade is on the CCJ. I plan to sell call options on that. And the premium is actually quite nice because it's very close to being in the money. So the stock closed on Friday at $10.94. That will expire on the 18th, which is next Friday. So that will be my first trade, and that will be on all 1,700 shares or 17 contracts is what I will be writing. That will give me approximately $425. And I feel fairly confident that I'll get that 25-cent premium, unless there's a big market drop down like last week, like last Tuesday at market open. Moving on to the Ford. So Ford, I am shorting that stock. I have 1,200 shares that I have in a short position. I should say the stock goes below $6.50. What would happen is my short position closes. So I take the profit from $7 a share to $6.50. So on 12, that would be roughly $600. So I'm limiting my max gain I can get through this short. But I am collecting a premium, and this is on the 25th, every 2 weeks. And so I'm fairly confident that I can get $7 contract on that. So even if it doesn't reach the $6.50, every 2 weeks, I collect 6 to 7 cents on my short position. And I don't have any maintenance or fees that are associated with going short on stocks. So I'll create another video at some point as to why I'm shorting Ford and go into more details there, but I do believe ultimately they will end up in bankruptcy. And I think that's actually the only way that that company will be able to survive. They do have a lot of debt that they have to pay off, and I think that is restricting their ability to move forward as a company. Okay, so let's move on to Tesla and my planned trades for next week going forward on the Tesla contracts. My overall strategy is to hold Tesla long term. So any call options that I sell, I always want them to expire out of the money. Last week I just sold a call option at $555. Just arbitrarily chose that value without any data to really back that up. So I got to thinking about it this weekend. one thing that I was interested in knowing was actually the percentage of increase that's ever occurred during one trading week. And so I went to the Yahoo site. They have historical data that you can download into Excel. So I just went back the last 1.5 years. The company has grown quite a bit since then. And I think it's really only relevant to look at the last 1.5 years. That's what I did. Chose 69 weeks based on that. And then I looked at the Friday close to the Friday close. What was the percentage gain in the stock price on any given week? And what I found was roughly 6 of those weeks out of the 69, roughly 8.7%, we had a 20% gain in 1 week. And there was one instance where it was actually above 30%, 31.57, and it occurred in April from the 13th to the 17th. So I kind of use this data as a basis for then setting my call option strike price for going forward for next week. It should never reach 500 as a result of that. So I'm going to choose around 494. That would be above around 495 for the very first one. And there is some flaws to this because options can still be executed or assigned after the market close on Friday. I don't have data on how far that could go. So there is kind of a flaw with doing this model. And as an example of that, we can look at actually last Friday. So at last Friday, that's when S&P announced that they're rebalancing and Tesla was not mentioned in there. And the stock dropped considerably. That would happen right after the market close. As a result of that, options can still be assigned if they weren't closed out on that Friday. And so what I may have to do with these call options is just not let them fully expire worthless, and right before the market closes, trade that option or buy that call option back again. So I'm still debating whether I'm going to do that. I may do that for this 495 if I feel like it's close to being in the money. Then I may close these 2 positions just in case something major announcement happens right afterwards that drives the stock price up. Then I would have the potential of losing those shares even though the market closed. Those call options or options in general can still be assigned or still be executed up to 1.5 hours after the market close on the Friday. That's something that could happen after hours, and then that could be a potentially much larger increase. And I don't have visibility on what that is because that's not something that's recorded on this historical data, what that after hours price is. So there's still a slight risk with the model. It is slightly flawed, but it does give me a good basis for setting up my call options that will expire out of the money at least 99% of the time. And so what this allows me to do is basically collect a $200 premium, and then I can use that $200 premium towards purchasing additional Tesla stock. But since my margin balance is so high right now, in my opinion, I'm going to use this to basically pay down my margin balance. And so this is actually quite a nice premium of $818 planned for this week. So I'll get roughly $225 from the Tesla selling of the call options. I have over 300 and some shares, so I can write up to 3 contracts. And then the very last one that I'm going to do is Square. And Square, I have it set to 80. In the last video, I recall that I mentioned I don't try to time the market and sell options right at the market open. In this case, this marks kind of a low point in Square. So Square is pretty much at its lowest point ever for the entire week. 80 cents for the contract, which translates to basically an $80 premium. And the reason why I'm doing that is I feel like that's kind of the low point for the stock, and it will go higher at some point during the week and trigger at least an $80 selling of the call option or 80 cent premium. So right now it's sitting at roughly 64 cents. I do believe it will be much higher than that at some point during the week. So I'll set up a limit to sell that call option at 80 cents and collect the 80 premium. If it doesn't execute on Monday, then I may either sell the 2-week contract out for 187 or 190, or I may just hold it another day and then see if I can get that 80 cents premium. And if I can't, then I'll likely just go ahead and sell the 2-week call option at that point. But I do feel that I can get a much better premium than 60. That's actually quite low. And when it was at that stock price last Tuesday, with only 4 days, I got a $1.69 premium. So in total, these are my planned trades for next week. All of them would expire on Friday of next week at market close. 1.5 hours after, actually, with the exception of the Ford. With the Ford, I plan on riding the 2-week option because the premium is actually so low. And this would only be assigned if the stock dropped below $6.50. It wouldn't be assigning the stock, it would actually be closing my short position. So I'd be fully out of the Ford stock at that point. So my short position in Ford would be closed. So it just limits my gain on the downside, but then I still get to collect a premium for holding the stock short. And I only hold that stock short in case there's a major downturn in the market. So ideally that should drag all stocks down, including Ford, and that would give me a profit. That would also clear up the maintenance, because my maintenance on that is roughly $6,000. So then I would have additional margin available to purchase other stock that I may feel that is a good buying opportunity. But at this point, since my margin balance is so high, at $60,000, which is roughly 2/3 of my account, I am going to bring down that balance versus purchasing in more shares at this point. So in conclusion, that's my trades for the week. All right, bye.